Sorry about that, guys. Hi, everyone. I hope you can hear me okay. And I've just thrown up the slides there on the screen, so hopefully you can see them. Thanks very much for joining this presentation. And I'm joined by two of my colleagues today, Keenan Cunningham, who's our head of marketing, and Clean O'Donoghue, who's our director of business development. And I'm just going to run through the next kind of 30 minutes or so, just giving some financial guidance and advice to people who work in the tech industry. We are going to try and make this session as informal as possible, so please do feel free to ask questions. Kalina can direct you, who will be sort of, I suppose, taking charge of that during the course of the call today. So
yeah, just I suppose, Nick, to mention where to put the questions in. So the Q&A function at the bottom of your screen, you can put the questions in throughout and we'll address them then at the end of the meeting. And the more questions, the better. Thanks.
Great, thank you. Okay, so just very quickly, for those of you that are not familiar with these, we've done quite a number of these webinars over the last number of months. My colleague Keenan has just put up a poll, which is basically just trying to get a sense of, you know, how things are in the tech industry. We appreciate that it's been a very challenging environment over the last, I suppose, year or so. And we are, I suppose, providing these complimentary webinars to individuals, and we have tailored them. We are doing one later on in the month in relation to mortgages, if anyone has a mortgage or indeed looking to get a mortgage, about some guidance on that. And we will be doing further sessions as the year progresses. So please do feel free to look out for those. So just, I suppose, I can see you're populating the chat, the poll there now. And just while you do that, I just want to tell you a little bit about Alpha Wealth. For those of you that are not familiar with us, we are a financial services company. We are independent. We have 8 qualified individuals, primarily based in Cork. We have a small presence in Dublin also. And we're giving financial guidance to individuals in all different sectors. Obviously, today's focus is for those of you that are based in tech, but it also applies equally to partners, spouses, and so on. So just to get into it, what we'd like to get from this talk today is essentially helping you to financially plan and making sure that you're doing the best you can in the environment that you're in. I mentioned briefly about mortgages, which we're just going to touch on today, helping you to understand your pension options and particularly redundancy options if things do happen where you are made redundant. And then lastly, about reducing the tax that you suffer and potentially an option as an alternative to shares. So we're going to run through those, as I said, but please do feel free to populate the Q&A with any questions that you might have. So just briefly, in relation to the tech sector, and I've just thrown up a slide here with some of the share price performance of some of the companies that some of you may work for. On the left side of the screen there is actually Apple. You can see in the middle Amazon, and there's also Microsoft as well. And obviously, it's been a fairly challenging year, as we've seen, in terms of their performances over the last 14 months since November 21. And obviously, we're all familiar now with a number of the announcements that have been made by tech companies. Now, I'd like to try and focus on the positive today, which is that I believe that we can all financially plan and budget and become financially independent. It's a case of just trying to sort of get a sense of exactly where you are and making the most of the opportunities that are presented. And I talk about a financial plan, and whether your objectives are to save for your retirement years or to help your children through third level education, paying off your mortgage, getting a mortgage, I think certainly the most useful thing that I can suggest to you today is to make sure that you do a financial budget. It's a really sort of powerful exercise. It's a simple thing. It takes 15 to 20 minutes. We suggest that you do that with your online banking app open or a month's worth of bank statements. And we have this available on our website if you want to download it. My colleague Keenan will actually put it into the chat as well that you can access. And it's really a case of just checking in with a financial advisor and helping them to help you make sure that you're doing the best with your money. And as I say, this is part of the process in which we help individuals with, but it's something you can do yourself as well. Just moving on from that, we talk about, I suppose, your goals and what your objectives are, and we'd like to compartmentalize them into short, medium, and long term. And you can see there on the screen, we break that up into sort of anything from 0 to 3 years is typically classified as short term. 3 to 20 years plus, depending on when your retirement age is encapsulated by medium term, and then long term is obviously your retirement years, the years that you want to be able to not have to work. So just before we get into, I suppose, the nuances of the I suppose today's webinar, I just want to talk briefly around savings and helping you to sort of get a sense of how we help our clients make the most of their money and get your money working harder for you. Now, this example on the screen is showing, and again, it was a recent webinar that we did, which is available on our website to download for free, how to save 30,000 over 4 years. And I suppose a key thing that I'm trying to get across here is that it's really important to understand what rate of interest you're earning and to get the best rate possible. The example on the screen here is a rate of around 3.5%, which is available through some of the insurance providers. And it shows that you can basically get to the same point, the 30,000, saving 570 euros a month versus 625. Now, again, this is just an example. You can see other examples there on the screen. And I suppose the main thing really for us to help our clients understand is that you're not necessarily getting the most from your bank, and knowing that you are sending out your objectives. And this is what we help our clients understand and plan for. The next slide on the screen, you can see specifically the example, and I've thrown up just an example of 500 euros a month, showing you what you can generate over 3, 4, and 5 years. They're in the yellow, green, and orange boxes on the top half of the screen. And at a very sort of high level, you can see there that anyone who saves 500 euros a month over the next 3 years will generate roughly about 19,289 euros if you achieve the 3.5% interest rate, which I believe you should look to achieve, even if it's just to keep pace with inflation. Over 4 years, that figure grows to 26,000 plus, and then obviously 5 years, 33. And I suppose what I'm really trying to show is that if you look at the bottom half of the screen where you leave it in the bank, and being fairly generous with 0.5% of a net interest, which the banks are not currently paying, you can see the same figures and how much they are lower by. So under the 3-year term, it's 1,100 euros, 4 years, 1,873, and then 5 years. And that's purely on the basis of compound interest. We talk about the effect of earning a return and earning it over a period of time. And I think that's a really powerful thing that people should take from that. Again, just in terms of areas that we can help people save money, mortgages. There will be a webinar that we're doing on the 21st of February where we're going to get into a little bit more detail on this. I think it's a huge opportunity for people to save money, whether you're on a fixed rate mortgage for less than 3 years, a tracker, or a variable rate. I would really encourage you to explore that further, or indeed if you're looking to get onto the mortgage ladder. We help our clients in terms of insurances, reducing the cost of things like mortgage protection, house and car insurance, as well as helping you to understand and navigate loans that you may have, health insurance, previous pension schemes, and savings. So I'm just going to talk briefly now.
Nick, can I just
mortgages.
interrupt you here on this?
Sure.
Sorry, can I interrupt you and just ask you one question? I suppose, given this recent article in the press, are banks still lending to employees in the tech sector in terms of mortgages and everything like that?
They are, and whilst I suppose Bank of Ireland are looking for these, what they call letters of comfort from employers, many of the banks are still more than happy to lend to people who work in the tech sector. And I think it's really important, I suppose, again, just to make sure that you're getting proper advice. And typically, we're going to talk about this more on the 21st of February, but we help people understand around, how they can get a mortgage at the best rate possible. It's not just about going to your local bank. We feel it's really important, particularly in this environment, to make sure that you're doing the absolute best you can.
And what about, I suppose, for people, there may be a lot of movement in this sector as well at the moment. If people are on probation, can they apply for a mortgage?
Yeah, it's interesting. There's a bit of a misnomer that you can't get a mortgage if you're on probation, and unfortunately, some people who have changed jobs, for example, may feel that they have to hold off until they are made permanent in their position, and that's not correct. We've had situations where people have been approved for mortgages, and if you think about it, the banks want to lend money. That's their business. And obviously, if they see, again, based on your situation, that you've worked in a company, yes, you may have changed jobs, but that you've got a continuity of employment over a period, that they're happy to lend. And we've seen clients that have been in the middle of their probationary period be approved for a mortgage. So again, it's something that I would suggest, particularly in this really challenging environment of trying to find a property, that you shouldn't hold back and wait until you're made permanent. I'm just going to talk a little bit about retirement planning. And again, I suppose I'm coming across clients now in the tech sector, and whilst there is that uncertainty there, you can only plan for the now. And I say that to all people, it's about making sure that if you're paid a salary and if you're subject to tax, particularly at the higher rate, what can you do to try and mitigate the tax you pay? And even if it's the case that, you are worried about maybe losing a job in a few months, I would still make the maximum benefit, and using your pension, I think, is a really effective tool to use. Some people don't necessarily know that there are very generous limits to paying contributions into your pension. It's not just about the contribution your employer asks you to make to get the same effect. So for example, a lot of companies, there's like 5% of an employer contribution if the employee puts in 5%. But based on your age, and the table on the screen there shows that for someone, say, in their 30s, you can put up to 20% of your salary, and that might be out of a bonus that you receive, and get 40% tax relief. And that does not include the employer's contribution. Some people think that the employer's contribution cuts into that. It doesn't at all. So again, the example I've used here on the screen is that the reason why I'm saying put money into your pension is that for every €1,000 you can contribute to your pension scheme, if you're earning over 40,000 a year, you will get €400 back from the taxman. That's a 66% gain. If you're in your 40s, and if you are earning, and the maximum cap of the earnings level that they use is 115,000, that enables you to put a maximum of about €28,750 into your pension. Now, again, I appreciate that not everyone is earning 115,000 plus, but even if you're on 50,000 or 80,000, you can get a sense of the scope and why that 40% tax relief is really powerful. Okay. Moving on, if you're leaving a company, or indeed if you've left employment, a lot of people have changed jobs over the last 2 to 5 years. There are options that are presented, and some people leave their pension schemes in previous employments. I'm personally not a big fan of doing that. You lose visibility of the scheme, and it's not necessary. There is the option of transferring it to your new company pension, but there's also the option of transferring it into what they call a pension bond, or there's another term used, which is called a PRSA. Now, without getting into terminology today, I feel that this is certainly an option to consider on the basis of being able to draw your pension entitlement down early, particularly from the age of 50 years onwards, which may enable you to reach other financial objectives that you have, for example, buying a holiday home or becoming mortgage free. But also that if you've been working in the company for, employed in the pension scheme for 2 years or less, that you may be entitled to take back your contributions, less a 20% tax rate, which effectively becomes a very favorable savings scheme, given that you got tax relief at 40%.
So Nick, for somebody, let's say, that's been made redundant, should they waive their right to tax-free cash or preserve it?
So basically, just to explain the question, what happens is that if you are made redundant, you're given a severance in many cases. And one of the options that you have is to choose whether you take a higher sum now and forego the benefit of the tax-free cash when you draw your pension scheme. And people would have thought that in most cases that would be sensible. Now, interestingly, because of this PRSA that I mentioned earlier, and again, not to get into too much terminology today, you can actually waive your right to the tax-free cash, get the higher benefit now, and by moving your pension into that PRSA, you are legally entitled, and revenue are absolutely fine with this, to draw down your tax-free cash as well. So what I'm really saying is that if I was in that position, I would waive my tax-free cash. I would take the higher benefit, but I'd also be looking for my tax-free cash when I draw my pension down. You can basically get it all.
So for anybody maybe on the call who has maybe moved jobs already, or maybe moving in time, like you've mentioned about just the options with moving pensions or leaving them with your current employer, and you've said you're kind of unfavorable to leaving them with the current employer. Can you maybe give just a little bit of background around that and why that is the case?
Yeah, the thing is, we're talking now about kind of phased retirement. You know, when I talk about retirement, I'm talking more about financial independence, like not having to work. You know, people may choose to. I'm 49 years of age. I may work, and I'm going to show you briefly in a moment about what my financial plan looks like. But the reason I don't like leaving pensions from, you know, in previous employments is that, as I said earlier, you lose visibility, but not only that, you lose the right to be able to draw them down at different stages. So again, it might help you in terms of this phased retirement where you might want to work less hours, maybe part-time. You may want to change careers, you know, go into a different industry. And by being able to access these different pension pots at different stages of your life, I think is really powerful, and it's really worth exploring for the benefit of the fact that these pensions that you move, as long as you make sure that they're in a good provider at a low fee, which is really important, and I'm really keen to make sure that people pay the lowest fees possible, that it can actually work out more favorably.
Okay, I have one or two more questions, Nick, actually, if that's okay.
Yeah, please.
Just before you move on, can you just clarify exactly what you mean in point 4 on this slide, please?
So point 4 is saying that if you've been you could have been employed by the company for more than 2 years, but if you've been a member of the pension scheme for less than 2 years, most companies automatically will take back their contribution, and that you are forced to take back your contributions less 20% tax. So sometimes this is a forced situation rather than chosen. But in some instances, it might actually serve you. You know, as I said, getting the money back, less 20% tax relief. Now, it can vary because some companies will allow you to keep their contribution, the company's contribution, if you retain the monies in a pension scheme. But as I said, that's an option that we can get. And for anyone that does leave a company or has left a company over the last number of years, we get the leaving service options form, as it's called, which states those 4 options, and we help you understand them, and we basically hold your hand in making the right decision for you.
Yeah, and I hope that has answered the other question that has come in around what is the best process for somebody that hasn't worked for more than 2 years in a company. So you'll provide your details anyway at the end of the
Absolutely. And as I said,
yeah.
This is something that we're more than happy to help obviously people with, and this is what we do. In terms of the financial roadmap that I spoke about earlier, what I think is really important, okay, is that people understand where they are today in relation to trying to achieve financial independence and really where they're going. Now, I've put my own situation up on the screen there. You can see I'm 49 years of age. I am basing my retirement age at 63, which is the age of my youngest child. My current pension fund is worth 220,000, and that blue arrow is pointing to my projected fund at retirement. It's based on assumptions, conservatively, of 6% growth, 3% inflation, which I think is a reasonable rate longer term, and how the effective inflation will affect my pension value, which is bringing it down, as you can see on the right-hand side of the screen there, to 481,000, and why that, in my view, is a reasonable amount. And I can explain in more detail to anyone who would like to get more information from me as to a viable pension option. Now, the key thing for me is to know that if I'm in a pension scheme where I'm paying a higher management fee, and really the management fee you should be looking for is about 0.75%. So for anyone who has left a company in the last few years or maybe leaving a company, the pension provider typically reaches out to you. It might be Irish Life, it might be Mercer, Aon Hewitt, or whoever. And it seems like it's a smooth transition, but it's not. They're actually looking to try and sell you a pension product, and the fees are vastly different to what you would have been used to. And all I'm trying to say here that is the difference between 1.25% and 0.75%, as I'm showing you on the illustration here, is that if I was paying a 1.25% management charge, the fund difference is actually 42,000 lower, or 28,000 in today's money. It's enormous. And the only differential between those two illustrations is a 0.5% difference in the management fee. And that's why fees are such a big thing. The other thing as well is that not all pensions are the same. I've spoken to people in various different companies. I was doing a presentation to some employees of Twitter recently whose pension is managed by Irish Life. And as an independent broker, I feel very strongly that it's really important to not only make sure you know where your pension funds are managed and that they're in the right risk level and in the right asset distribution for you, but that you're in the right company as well. My personal preference would be Zurich over Irish Life, and you can see on the screen why. Again, it's a little bit fussy, but basically the green line is a Zurich pension, and then the darker line is also for the same risk category. Sorry, the red line is a lower risk category in Zurich as well, which actually meets and betters both the Irish Life higher risk and the same risk fund. So it's getting basically the same performance, but for lower risk. The Zurich account obviously is matched against the green line against the dark blue one. What that chart is basically showing you is that Zurich's funds have outperformed Irish Life's in both categories, and I feel really strongly that it's important to make sure that you're in the right one. I'm just going to briefly touch on redundancy. Now, again, I don't want this to become a sort of a very negative kind of session, but it is relevant, I suppose, that for anyone who is being made redundant, we spoke earlier about the waiving of your tax-free cash. We can help you understand that and help you with the options, because I think it's really important. And whilst some people do get guidance from others that work in a company, it isn't always a one-fits-all solution. And I think it's important to make sure that you get qualified professional advice as well. I'm just going to touch on one other opportunity for people to reduce tax. And there's only really two ways for POA individuals. One is pensions, but the other is a government scheme called the Employment Investment Incentive Scheme. This scheme has been available for, I suppose, 13 years now, where high rate taxpayers can benefit from essentially lowering the rate of tax they pay by making a contribution into a qualifying company. And I'm going to talk very briefly around the opportunity, but I think it's certainly something that people, if they are made redundant and have a sum of cash paid to them, or if they have money in the bank, it really is worthwhile considering, particularly perhaps as an alternative to buying shares in the company, which basically doesn't provide diversification, and I think can be quite risky, as I've shown you on an earlier slide about how the performance of some of these tech companies can obviously go.
Okay, so I'd just like to address one of the questions that's come in as well. If I receive shares from my company as a bonus after 3 years, how much tax am I liable for?
So generally speaking, the tax treatment on shares is 33%, which is capital gains tax on the profit that you've made. Now, often employees of companies aren't really sure about how to pay the tax and how to actually work out the tax. It's very simple. Again, it's something that we help individuals with. It's a simplified process. We get the cost that you paid for the shares, the cost that you sold them for, and we work out the tax liability and help you understand how to pay it through the Ross system. It's really straightforward. And it might be going back a number of years, and it might be helping you to assess. The key thing is, though, I am encouraging you all to consider selling the shares that you buy. I have no issue with you buying the shares. I think it's a good idea. You generally buy them at a discount, and they are quite favorable tax-wise, but that you shouldn't end up with a huge amount of shares. And I do feel from a diversification point of view and obviously risk, it would be sensible for you to do that. I'm just going to talk briefly there about the opportunity I've just explored there with the EIS scheme. Now, I'm not going to go into huge detail, and there is an 8-minute clip that we can send you explaining this in more detail to you if you're interested. But again, I think it's a huge opportunity, particularly for anyone who has money in the bank or may be able to generate at least 5,000, if not 10,000 this year, where you put that contribution to one of the qualifying companies. We help you identify the best in Ireland. It's about 70 or so each year that look for this type of finance. And essentially for 10,000 of an investment, you get 4,000 back from the Irish government early in the following year. And then at the end of the 4 to 5 year period, you get your 10,000 back plus interest. I think this is a really powerful tool to mitigate against the tax that you pay.
So, Nick, I just wanted to ask you another question here, sorry, around the shares. You suggested kind of selling shares, and regarding the shares, even if you're selling them at a loss, would you still suggest this?
I would, and whilst some people may not agree with that, The reason why I say that is because anyone who has a view on the share price of their company, and I respect the fact that obviously those people who work in the company may follow the shares quite carefully, but nobody knows what's going to happen to the share price in the next 12 months. They don't. I have a lot of experience and expertise. I have an economics degree from the London School of Economics, 25 years of investment banking background, and I couldn't tell you definitively what the share price movement will be in the company that you work with. The key reason why I suggest that people sell shares frequently is that it does reduce risk. You're buying and you're selling and on an averaging process. And even if you lost money on the shares that you sell, you can use the loss indefinitely for periods where you get benefit. And also by you diversifying into other schemes like the EIS scheme, where you may make a capital gain, you can offset that gain for the loss of the shares that you sold. So the key thing about it is that don't be a speculator. Accumulate the shares, hope that you at least break even, if not make a profit, but that you do on a consistent basis. And then it's just basically you trying to build your overall net worth and building a portfolio in a more diversified, less risky fashion, I should add.
And Nick, on that, is there a recommended amount that you would suggest putting into EIS in your opinion?
Well, the opportunity is really all of the tax you pay at the high rate. So for example, if anyone's earning between basic and bonuses, say 100,000 euros, when you start paying tax at the high rate, which is typically the threshold of 40,000 a year that you can earn before you do that, you're liable for 60,000 at the 52% rate. And therefore your opportunity for EIS is 60,000. In answer to the question about how much you should invest in the EIS, the scheme is likely to be available for the next 2 years, so this year and next year. We don't know if it will be extended or indeed cut short. Personally, I feel that if anyone hasn't availed of EIS previously, it's a case of trying to like dip your toe in the water. So we have many clients who are putting in the minimum contribution of 5,000, and we have those that have the money sit in the bank idle that isn't doing much for them, or may have received a bonus that they've been taxed quite heavily on, that basically contribute that towards the EIS scheme. So it varies really, but anything from sort of 5 to 25,000 are the typical contribution levels that we're seeing.
And is there a full list of the companies that are eligible for EIS, or the ones that you would maybe recommend?
There isn't a list of the full companies available, but there is, I suppose, a list that we provide, and we showcase the best companies, and we have a lot of experience and expertise. And again, we're not biased. We provide the names and details of the companies. We do the application process for you at a small fee, I might add. Typically, the cost that we benefit for the scheme or charge our clients is around 100 to 200 euros in total. That's for the full process of setting the scheme up, the advice, and managing the scheme for 4 to 5 years, which is why a lot of advisors don't do this. You know, it really doesn't pay. But I feel it's a great opportunity for people, particularly in the sector where you may have some money from a bonus or, you know, severance at any stage where you say, okay, I want to try and reduce the tax that I pay. So we provide you the name of the companies. There are a number of companies that we've showcased previously. There's a court-based company that we're promoting to individuals who raised money successfully last year, a renewable energy fund based in Dublin. And there's a variety, and we basically narrow them down in different sectors to provide that diversification.
And in terms of the return, let's say on an EIS scheme, can that be put into my pension, let's say, or am I caught for capital gains tax on that?
So the example there on the screen shows that if, let's say, you did invest 10,000 into EIS this year, you'll be eligible for the 4,000 euros back from revenue, which is your tax back, which is not taxed, typically in the first quarter of next year. So that's Q1 of 2024. And yes, you can reinvest that money into your pension. So you get kind of a double win because you're getting tax relief, obviously, on that contribution also. And at the end of the 4 to 5 years from the time that you make the original investment, you look to get your 10,000 back plus approximately 20% profit, which is liable to capital gains, but you'll only pay a small amount because you're eligible for an annual allowance. And that money can also be used then to invest in your pension scheme. So it's really a case of recycling the money. And that's why we're helping our clients basically to understand about how you can really get your money to work harder for you and to grow.
Can you just give a bit of clarification as well around, it just says, do you have to keep your money in this scheme for 4 to 5 years, or can you take it out once you get your 4,000 back from the Irish government the following year?
There are a couple of drawbacks of EIS, and again, this is what we help our clients understand and we provide you information of. So the plus points are obviously that you get a huge tax saving and that you get growth on your investment over that 4 to 5 years. The drawback is that you have no access to the money. The company decides when it can redeem you. It must hold your money for 4 years for this to qualify. And obviously the expectation is that you get the money back, well within the 5th anniversary. So the period I use is 4 to 5 years because you need a little bit of time for the company to obviously repay you. So that's a downside. The other downside is risk. It's evident and there's no point me disguising it. There is risk with you making that investment. The key thing is that you understand the company, that that the company has a trading history. I would never invest in an EIS company that hasn't had revenue generation, and we get you to look at it. We've provided a lot of detail to our clients. I visited actually the site in Kinsale of the EIS company to really understand the opportunity and give clients the same opportunity if they wish to know exactly what they're doing.
And in relation to claiming the tax back, do you have to claim it back from revenue, or do they add it to your annual tax-free allowance?
Generally speaking, most of our clients who make the investment, and if you think about last year, they're now duly going to receive their certs over the next 2 weeks. Typically, we help them get the tax credit. So the 10,000 example I use, the 4,000 euros, by going onto the ROS system, making the claim with the cert that they receive, and they typically get the 4,000 refund within a few weeks. So it's a tax back payment that they typically get.
I'm going to jump back to the slide you showed on pensions and the performance of the different pensions, where you looked at Irish Life versus Zurich. For somebody with an existing pension in Irish Life, can they move that to Zurich?
If your company pension scheme is with Irish Life, no. But I suppose the key thing then to understand is what are your options within Irish Life, and make sure that you're in the best option for you. So depending on your age, and I talk about risk and reward, the multi-asset portfolio 5 in Irish Life, as an example, is a risk level 5 fund, which wouldn't be appropriate for someone in their late 50s or 60s, for example, would only be more appropriate for someone in their 30s or 40s. But also, the blended approach of saying, well, okay, I understand, the performance of that fund, the nature of that fund versus the other options that are out there. So you can see that the multi-asset portfolio has underperformed the consensus fund, which is not good because it's actually a high risk fund. So for me, that's an underperforming fund over a very close alternative. And this is what we help people independently understand. We have no bias because obviously we're not looking to sell you a pension, but this is where we can help you understand which fund you're in and what's the best fund available to you.
And can you maybe just explain as well the costs associated with anybody who is looking at moving a pension?
So generally speaking, and sorry, I should have said there that what we offer clients is, for anyone that listens to the webinar, our normal consultation process takes an hour. We do it generally online. We can do it in person if people prefer, with your partner if it's appropriate. And essentially the reduced cost is 99 euros from 199. And we provide all of the information that you require. We do the heavy lifting. We get the information on your behalf. You don't need to go finding details of your pension and so on and so forth. And essentially, we explain to you about what is involved in terms of what's the best option for you, whether it's moving an old pension scheme to a new provider, and how that typically embroils. Generally speaking, there are no costs to transfer your pensions. There shouldn't be, and you should be very wary about anyone that's looking to try and transfer a pension and charge you money to do so. The cost is really typically the management fee. And I mentioned earlier about, making sure you're not paying over 0.75%, because as I said, if you are moving your pension scheme, and it's important to get information which we'll provide you in writing so that you can review it, that it's the comparative between what fees you're on versus what you're going to be moved to, and to make I suppose, an informed decision on that basis.
For somebody else as well here, they've said that they're no longer on an Irish Life pension, that they are under a master trust pension. Can you just maybe give a little bit of clarity around that and just explain that a little bit, please?
I think there's probably a slight misunderstanding. The master trust is just the name of the vehicle, but it's still managed by a provider. So it could be Irish Life. So you could have had an Irish Life company pension plan, but you could still have an Irish Life company pension plan under a master trust. It doesn't change the provider. So maybe there's just maybe a bit of clarity on the question itself. But so from that perspective, there's been a slight movement of, the way that pensions are managed, and there's a lot of terminology, as I've said earlier: PRSAs, master trusts, one-man pension arrangements, executive pensions, company pensions. We can help you understand them, but the key thing is, your pension has to be managed by somebody. It's either Irish Life, Mercer, Aon Hewitt, Willis Towers Watson, Zurich, or whoever. And all we're saying is that we can help you make sure that you're in the right fund for you and have the best option, whether it's in your present company, in your previous company. And that financial projection that I showed you earlier, I think it's really important for you to know what yours looks like. And only by knowing that, you can help yourself, making sure that you're checking in and where you are and how you're going to get to that point. And a lot of things change in life. I moved from a PYE role to become a business owner 9 years ago. And, things do happen in life, and you need to just make sure that you're kind of adjusting and that you're reviewing this on an ongoing basis, which we do for clients. And this is the important thing. Whatever you set your plan on now, you just need to check in once a year and make sure that it's still on target, and has there been any reason for changes. Obviously, if you change jobs, you've gone up a pay scale, you've received a bonus and so on, that you just make sure that you're doing the best with it that you can.
So what about for somebody that has their savings currently with their local credit union? Is this viable, and what would you advise?
When I spoke earlier about, the compartmentalization, breaking it up into short, medium, and long term, the credit union is only applicable for anyone who has short-term objectives. If you need that money within 3 years, the credit union's fine. If you don't need it within 3 years, it's far from fine. And that's the general rule of thumb for every banking institution, I should add. Post office, banks, credit union, again, only applicable for anything less than 3 years.
And is there anything that you'd advise that person to do in terms of looking at different options available?
Talk to us. Honestly, I'm not being facetious, but I think it's really important for people to understand what the options are out there and to get proper advice with no obligation. As I said, the only cost that we charge is 99 euros, and we can lay out options for you in a very non-salesy way that can help you understand the best options that suit you and show you what these, I suppose, projections are going to look like, whether it's to save for your kids, save for yourself, pay down a mortgage, invest the money, and make sure it's the right product for you at the lowest fee possible.
And I suppose it's important as well, as Nick, to mention, I mean, a lot of people here are working probably for companies where the pensions are provided by the likes of Irish Life, and they may not have reviewed these funds for many, many years, or different providers, and you can help with that also.
Absolutely. That analysis that I showed you earlier, the comparative between Irish Life and Zurich, we model that specifically per individual that we speak to. So we'll show you what fund you're in versus the options that are out there and help you make an informed decision. And I appreciate some people may not be familiar with this. It's, again, I don't profess to know a lot about tech. And this is why I think it's important to make sure that you speak to the right people. It's getting guidance from people that are understanding. And we explain it to you in a manner that I think should hopefully make it, clear to you that you at least have a bearing about, what you're invested in and that it is the right fund for you.
If you wouldn't mind sharing your contact details, Nick, because I think we've come to the end of the questions, just for anybody that may want to get in touch with you following the meeting. Thanks.
Sure. So just to quickly summarize, and thank you very much again for your time. We do provide, advice to people on mortgages, savings, pensions, protection, all types of protection that we can help you reduce costs on, as I mentioned. Estate and succession planning, I haven't really spoken about, but again, these are, separate webinars that we've done. My contact details are on the screen there. My email address is very easy. It's just nick@alphawealth.ie. And obviously you can make contact with me directly, or you can give me a call on my mobile. We're happy to answer any questions, by the way, guys. And if anyone does want to stay after, and maybe I'll just leave the webinar open if you want to pop a question into the Q&A, we will respond.